ladies and gentlemen. Thank you for coming. Welcome to the first quarter 2018 results. From the right side to the left, we've got Sanjay Ahuja, Uday Gill, a local lawyer, DK Agarwal, and Mr. Alexander Erhan, who will be helping with the IR work from now on. So you should get his name card at any time now. And if you gentlemen would like to start, please go ahead.
Thank you, Richard. Good afternoon, ladies and gentlemen. Welcome to our first quarter earnings review. Mr. Agarwal will be taking you through the presentation. I would like to just share with you some organizational changes that have taken place earlier in the year. And most of you are probably aware of this, but, since these changes impact you, maybe I thought I'll share my thoughts, why we are doing it, what we are doing. So, as you can understand, in a growing organization like IVL, it is only natural that we will see career progression and alignment of roles with external needs going forward. Vikas Jalan, all of you have known him now. I think Vikas has been on investor relations since the IPO. He has been now moved up into the role of a CFO at the PET division. So this will be great for him. He'll get some deeper insights into the businesses. And as you know, PET division is one of our, or it is our largest division by itself. And he's lucky to move into the PET division, which is showing remarkable progress at this time. His role in the IR is now being handed over to Alexander Heran, who was doing the strategy. They were sitting side by side. They were working together. Now, Alex has been given the responsibility to lead both the functions of continuing with his strategy, but also including IR. And this will be, I think, good for the company, good for all of us, because he can provide richer insights on the industry, on the corporate strategy, and share with you from a IR standpoint. Their teams, Thanisha, Ponpriya, and their teams, they will continue to support Alex on corporate strategy, while Supika and Pimani, who were working under Vikas earlier, would now work together with this larger team of corporate strategy. So combined, it will also give more exposure to these individuals, which is great for them individually. So I think it's a step in the right direction. Naveen Sudha, is she here? She's coming? Okay. Naveen Sudha has been given a larger responsibility in corporate communications. She has been with Richard. She will continue to work under the guidance of Richard, but she's been told that she's responsible. So if there is a mistake in the communication, please blame her. Robinda, you guys, he's been with us for a year and a half now. Robinda will continue to oversee the initiatives and performance with a view of creating basically a world-class IR and a strategic communication practice at IVL. So congratulations to all of them. Just in case, I think you all of you know them, but why don't you just stand up so that everybody can get to know who you guys are. So Alex, Supika, where is Pemani? Please, where's Thanisha? There she is. Pia, please. So, great. So now we can start on the formal earnings presentation, which will be presented by Mr. Agarwal. Thank you.
Good afternoon, ladies and gentlemen. I think Vikas has been lucky for PET to start with a good performance for PET. We have started the year 2018 in a good throttle, I would say, a very good result. I also would say that acquisitions are easy, but integrating them and delivering the result is the most critical. So thanks to the entire talent group of IVL around the world, which has made this possible, and we have kept the momentum for second half of 17 results. Next. So this slide shows we exhibited significant growth on a year-over-year basis, achieving best ever performance since the company's IPO. As you can see, the core EBITDA of $326 million, which has increased 49% in this quarter, a significant increase. Core EBITDA per ton, which is a yardstick for us to measure our performance. We don't go as a percentage because, you know, the crude values keeps changing. Was $140, all times high, a demonstration of our great product mix, great geographical diversity, everything, integration. Core net profit of $175 million, and if baht weakens, the earning per share will further go up if the baht weakens, increased by 85%. Core earning per share of Thai baht 99 satang, a 55% increase year on year, even after post-dilution of 11% following partial warrant exercise. So you can see how the first quarter results have been. This performance is a result of our long-term investment strategy, as I said, integration, geographical portfolio, and start of earning recovery in necessity business. You will see in following slides that Asia just started recovering. So it's just the beginning, I would say. But HVA acts as a hedge because that's the high value margin business with a stable earning. So it's a great mix of necessities as an HVA. But necessity margins are improving, and which will make more significant part of the earning going forward. On the quarterly basis, this is repeat. Repeat. Yeah. Is it? Okay. Oh, there's some slight adjustments anyway. The total production is 2.3 million tons, which is 6% year on year. As I said, core EBITDA of $326 million, increased by 49%, driven by higher margins, with production, slight increase in the production, as you can see. The operating cash flow is pretty strong, with $249 million, which helps strengthening the balance sheet and fund growth plans, along with the warrant money which is coming in. And you can see the ROCE, return on capital employed, which has significantly improved from 12 to 17%. That's a significant increase of 500 basis points, and which shows the return on assets. Our net operating debt to equity has come down to 0.39, which is 51% decrease. So as the operating cash flows and the warrant money comes in, the net debt to equity has dropped to 0.39, creates a strong headroom for further growth of the company. This slide gives you the core EBITDA of first quarter and the LTM basis. As we said, the first quarter core EBITDA increased by 49% to $326 million year on year, with improvement seen in all the segments. Core EBITDA, as I mentioned, per ton increased to $140, a record high that has been achieved since the company's IPO. This demonstrates the quality of our portfolio, the geographical reach, diversified earning streams, and timely investments made in strategic feedstock. And Brazil is good timing. When the PET is so strong, we're going to close the Brazil deal of 550,000 tons by end of May. The first quarter 2018 production increased 6%, with 85% of this growth driven by brownfield expansions, operational excellence projects, higher operating rates, and the successful completions of the acquisitions announced in 2017. Well, how we delivered these results? Relentless focus on operational excellence, which is a very important thing. When you debottleneck the assets, your incremental cost is so low. Cost rationalization and debottlenecking the projects have all helped play an important role in improving each segment operating performance, as you can see in the core EBITDA. And the core earning per share on LTM basis is 3.27 baht versus last year 2.22. So you can see how the core earning per share is changing in last 12 months basis. Well, PET is the, as Rominder was saying, is star performer, right? Okay. The PET segment performance stood out as core EBITDA more than doubled, as you see, from $57 million to $116 million in first quarter 2018. What's driving it? The PET earning in the Western market improved on better price realization. You know, the industry was having very low margins for a significant time. And I always say in a commodity business, the margins go back to the replacement level of assets when there is a growing demand. And that's what is happening now. We are reinstating the margin where our more than 80% of the volumes are contracted. So they are linked to the raw material prices or contracted. So the earning is predictable. Asia PET earning also improved, supported by higher sales into premium markets. So what's happening? As you know that Japan had anti-dumping duties against China. So 450,000 tons of material, which was being shipped from China, is being shipped from Thailand, Indonesia at a premium. And that is the advantage of IVL global footprint. The first quarter 2018 production increased 8% year on year, with operating rates at 87%, underpinned by a stronger demand by our product, tighter global supply demand, robust operational performance across all our assets, and the ongoing structural changes in the PET industry has created the opportunity. Today, actually, China is running short of the product. So we feel that second quarter performance in PET will be even better than first quarter. So opportunity for well-managed and committed producers to align supply reliability and increase sales to customers despite the first quarter, which is normally a slower period. So customers are looking for supply at present. The entire system is tight. The China itself, as I said, domestic market is short as we speak in second quarter. And in spite of startup of some of the shutdown facility. So PET margins are recovering across the globe. Coming to fibers, the fiber segment delivered the robust earning. As you can see, the first quarter 2018 EBITDA of $55 million, which is an increase of 21% year on year. The production increase is about 6% year on year, with operating rates at very high, 95%, driven by strong demand growth for our products across all segments and regions. Volume impact of Glenstoff and Durafiber acquisitions, which were completed in 2017, contributing to 77% of the total increase in volume. So what you saw came from the acquisitions and higher operating rates. This increase in production was offset by lower volumes at PHP plant in Germany due to force majeure by raw material supplier. So that resulted in low operating rate. This business continues to benefit from a strong demand growth of 6 to 7% and stable HVA margin for automotive, personal hygiene, and industrial fibers. So even the fibers necessity business margins are improving. As we said, that there's a ban in China on the waste, which was converted into the recycled fiber, and the virgin fiber demand is increasing. So in the necessities fibers portfolio, margins improved in first quarter 2018 and are expected to continue to remain strong as overcapacity reduces and demand boost from replacement of recycled fiber and reduced cotton supply in China adds to a better performance. So even the fiber necessity side will add further margins in the fiber segment. Well, feedstock segment, the next, which is a very important segment, delivered very strong results with first quarter 18 EBITDA of $151 million, 29% increase year on year, as you can see, an LTM basis $535 million versus $373 million, a 43% year on year increase. The first quarter 2018 production increased by 5% year-on-year, with operating rates at 85%. I just want to highlight that we had $21 million of insurance claim related to machinery breakdown and loss of profit, which was accounted in first quarter of 18. So the increase in production was driven by the ramp up of the production in expanded PTA capacity in Rotterdam. We haven't started at full capacity yet, so the second quarter will get the full benefit of this and going forward. And remember, the PTA margin increase in Asia has still not translated in Europe because Europe has old contracts. And coming back in 19 with the increased PTA margin in Asia, the import parity changes which will improve the margins of PTA in Europe in coming quarters. Higher IPA volumes, we told you that we are doubling the IPA. We have doubled the production since January. It is still in a selling phase. So first quarter had some improvement, but the second quarter will have full results of doubling the IPA production. And the normalized production of glycol. And glycol margins, as you know, are quite robust at present. The higher PTA production in Asia to meet the increased polyester demand. However, as you know, because of the M&G bankruptcy, we lost one of the customers in Canada. So this was partially offset by lower production of PTA in Canada, pending the restart of Apple Grove PET plant in the United States. This plant is likely to start in June end, so our PTA supply in July will start to this plant. This segment benefited strongly from the West feedstock portfolio with higher volumes and margin in EG business. As I said, the glycol margins are strong. The ethylene cost in US is pretty low, so the glycol margins are supporting the feedstock business. And increased volume in IPA, which more than compensated the normalizing the margin. So we had a very strong IPA margin. They started coming down, but it is getting compensated by volume doubling, and that's what we had mentioned to you. However, we had a force majeure situation in first quarter of one of the refineries, which resulted into the mixed xylene supply issues and which affected some productions and also the margins in paraxylene. So this is in spite of that result. Well, this slide, which gives you core EBITDA by segments, by region, by HVA necessities, we give you in all different formats. So we continue to upgrade our portfolios through the organic growth and operation excellence initiatives, value accretive acquisitions which we have done, consolidation and strategic integration. Our diversified portfolio provides an earning mix that combines the higher volume necessity, 79% of first quarter 2018 LTM volume, now with improving margins and stable margin HVA business, which is 21%. And you can see the last slide, the necessities total, which is the West necessities. The Asia necessities are still not. I mean, LTM basis, if you see, first quarter is only 113 million versus 114. So Asia is still on recovery phase, and you will see this number going up as the Asian peat margins are improving. But the first time, the Western necessities and the Asian necessities total together made 567 million, surpassing the contribution from the HVA business of 542 million for the first time in several quarters. So what you're seeing is HVA stable earning, and now the necessity margins are coming back. So that's the last 12 months breakup of 112 million. Of course, North America remains a star with $501 million EBITDA. As you can see, the European section EMEA is $376 million, and the Asia is 234. So by region also you can see there. Well, this slide shows you how the different regions are changing. Asia, EMEA, North America in core EBITDA $1 million and per ton basis. Of course, the Western businesses are more consolidated businesses, which contributed 66% of volume and 79% of earning in first quarter 18. The Western businesses have also improved significantly, as shown here. The North American core EBITDA per ton increased to $195 per ton from $133 in first quarter of 17, as you can see in this slide, top, bottom there, where the production was 0.83 million versus 0.79. EMEA core EBITDA per ton, supported by HVA business and the European PET business, increased to $139 from $109 in first quarter of 17. And the Asia earning also improved, as you can see, the EBITDA per ton increasing to $85 from $58 in first quarter. But however, on LTM basis, you can see 75 versus 71. So these results are not yet reflective of the fundamental shifts in the industry, not yet. PTA, although we have seen the improvements in the PTA margin, it is not visible in the earning yet because of some historical contracts, as well as there are high coal and acetic acid prices. Acetic acid is very strong at present, and caustic soda, which negatively impacted. But we think the Asia PTA in second quarter will do better than first quarter. As PTA spreads continue to improve, driven by strong polyester demand growth, first quarter China growth was 10%, as against last year 11%. So in Chinese polyester demand is growing by 10%, a very strong growth. Capacity balancing, as you see, I was just saying China is becoming short because capacity did not come in line with the demand growth and disruptions, and today we are having shortage. Superior supplier configuration, we expect gradual recovery in Asian PTA earnings in the quarters to come. So Asia is still on recovery path. As you can see on the LTM basis, it's only $75. So that's where you will see an improvement going forward. This is a tsunami chart, which is basically, we used to present earlier, and we thought to give you an idea how the margins are changing. This is calculated based on per ton of PET, the spread in weighted average based on our capacity. So that's why how this is calculated, and it reflects our portfolio. So you saw 2011 a peak of earning, but that's a history. That's a different thing because that was driven by cotton shortage and the polyester entire chain, but that's not the thing we are talking about. So in last 5 to 6 years, the margins were squeezed. And if you capture inflation from 11 to 17, these margins are still much, much lower than the replacement. So you're just seeing a slight spike coming up here, movement. And as we'll present this graph in second quarter results, you will see a further movement up. So IVL is well positioned to benefit from this ongoing structural shift in its feedstock, PET, and fiber segment. We have capacity, you know, that and any $10 translates into EBITDA. After several years of oversupply, industry fundamentals are turning positive. Improvement in domestic consumption for polyester products in China, high demand for virgin material because of the ban on waste. Following the China import west ban and superior supplier configuration has created a more balanced environment, resulting in higher utilization rates and margin. And we continue to work debottlenecking of the assets and right acquisitions, operational excellence translates into the better EBITDA. So what's happening next? This is the projects portfolio. We continue to invest in the business to enhance overall production, vertical integration and quality of earning, and making sure that these people are integrated well. Integration, cultural integration of the people is most important, and we have the right talent operating the businesses around the world. Improved cash flows and ongoing commitment from shareholders provide the liquidity for several investment opportunities during the 2018-21 strategic plan. So as you see, first, doubling the IPA production, we just did. First quarter had part result of it because the sales is still ramping up. And then second start, we have the full benefit of doubling the IPA, which will further increase in 2019 with the additional matter being available. Full impact from Rotterdam production, which is in the ramping up. Heartland PTA of 700,000 tons, as I just mentioned, that the PTA improvement in Asia is not translated in Europe yet. So it's a good time to start Heartland with a 700,000. We are targeting in July to start up. Will further provide earning upside for the pigment segment for most part of 18 and for full year of 2019. Full year impact also will come from Glanstoff and Durafiber, as well as expansion of performance fibers in China, which was just completed in first quarter 18. We'll add production and volumes to the HVA portfolio. In addition, we continue to leverage our proven operating skills over the course of our history. We have been integrating number of assets always quickly with minimal disruptions. So Brazil, as we are targeting by May end, we seek to maximize our economy of scale and seek to run our facilities always at their maximum sustainable rates, thereby more effectively distributing the fixed cost. Any incremental production is at a very low cost through our integrated raw material supply. And we optimize our conversion cost by ensuring our assets run the latest possible technology. We operate most of the technologies in the world, whether it is PT or PET. So through, for example, debottlenecking or technological upgrades and always keeping a keen eye on the capex outlay, we are able to materially raise the performance of the assets, which is actually translated into the bottom line. We continuously strive to raise the cost competitiveness of our operation, as you can see. So in 2018, I think we'll talk further in the next slide. What are the projects? Well, the gas cracker, that's the big step which we are taking. As we said that it is in commissioning phase. Most of the commissioning has been done. We are doing the final HAZOP study. We expect to start this in July of this year, which will make it integrated from ethane to PET. And this will add the bottom line coming from third quarter as well as and the full operations in fourth quarter. Brazil, well, it cannot be a bad time to acquire asset when the margins in PET. The Brazil pricing is determined by import parity from Asia, is a 14% duty protection. So Brazil is a fantastic timing of acquisition, and we expect to close. We already received the antitrust approval for that. And you heard about this joint venture, PET, PTA, Corpus Christi, one-third, one-third, one-third. The failure, MNG's failure assets will further improve our earning potential. We expect, subject to all the regulatory approvals, the PET plant to start in July of next year, 19, and then the PTA later on. So this will add to the necessity business income. So these three projects are firm. So we only talk to you about the firm projects. We don't talk to you about the speculative projects. So, well, what's exactly happening? A good start. I think we delivered on what we told you. With improvements in the production volumes and margin across all segments, core first quarter EBITDA performance gives us a strong confidence. As you know, if you annualize, we are already at 1.3 billion, right? 325 multiplied by 4 is $1.3 billion annualized return. And in spite of that, there are many projects coming on. So our strong performance in first quarter 18 gives us confidence in our objective to achieve a 45% EBITDA growth in 2019 over 2017. So just to give a rough number, 17 we achieve $1 billion. 45 we were talking $1.45 billion. And today at quarterly basis 325 we are at $1.3 billion. So and projects to come. You saw the list of the projects. So wish us good luck. We announced earlier this year with the existing business and the ongoing approved projects. In addition to the previously announced investments, which we listed, $1 billion in 18 and 19, we anticipate a good investment headroom of $7 billion. The investment from this headroom includes acquisition announced and operating cash flow of $941 million, which is pretty strong, helps strengthen balance sheet and fund growth plans. As you know, the cracker investment will be eligible for depreciation. So our cash tax in the United States will be very low. We can claim the entire investments in there because we have a consolidated tax regime. So all these are important elements. We delivered strong results and expect this momentum to continue in the quarters to come. So thank you very much. And now we can take your questions.
Komsan from Patra. I got two questions. Number one is how flexible your MEG plan are in terms of ethylene sourcing between spot and contracted market in Q1 and going forward. And secondly, on a pro forma basis, what is the contribution cracker that you always mentioned about, like in Q1 and Q2, EBITDA generations from cracker for Q1? Thank you.
Just the last question. Repeat again, the last one you said.
I recall that you provided that with the pro forma or the contributions from cracker if they are producing.
Got you. So, Komsan, first let me give the good news which you wanted to listen. We are on spot ethylene basis, which adds significantly in the profitability of IVOG in second quarter because ethylene is cheap. We look this business as integrated between IVOL, the cracker, and IVOG. This is just a temporary phenomena where the spot prices have come down, but as the derivatives starts coming in, it has to reach to a natural level. But on an integrated basis, our pro forma EBITDA of $300 million, we are on the track for that, or 320 million roughly, you know. So we always look at integrated portfolio, and that's how it is. Our investment cost is low. We are at a good time to start with it, and we look this as an integrated business model. But I think the first question that we are on spot at present because of our expected startup. So, and we have covered most of ethylene.
Can I ask a follow-up question? What do you think the C2 price is going to be in the second quarter in the U.S.? Are you seeing the 350 to go on, or they should be going back to the contract 600?
Okay. So I have to elaborate this question. Ethylene is made from three cracks: propane, butane, and ethane, and of course the naphtha, right? Crude oil is going up. So the crude oil configuration based ethylene cost is going up. So right now what you are seeing, the drop in the spot price is because of high inventory, and some of the derivative plants are not running properly. Once this derivative plants start properly, you will see the spot prices coming back and migration of the profit. And you know the ethylene exports from United States is limited. You can't export because there are limited terminals. So although there is arbitrage between US and here, it's not. But the second quarter, as I said, we already hedged, completed the spot basis. So we are good to go. And that will be reflected in our IVOG profitability. In a positive note, because those who are not, that because of the cheaper ethylene, IVOG profitability will be better in second quarter.
Okay, anybody else want to ask a question? Please do speak into the microphone as this is being broadcast. If anyone would prefer to write a question on a piece of paper, please do. Hold it up and somebody will collect it from you.
Bawaramon from Credit Suisse. Just want to ask one question on the insurance claim that you mentioned of $21 million. What is the, where does it come from? And is it included in feedstock division and your calculation of the EBITDA per ton? Thank you.
EBITDA per ton. So Alex, that's where you will have to help me. So $21 million is included in the feedstock EBITDA. It came from, you remember in 2016 we had this interruption, we had some issues of the plant, and we have loss of profit and machinery breakdown policy. The always accounting of such insurance claim is done on cash basis, and that's why when we receive the cash, we have accounted on the cash basis, but it is included in this. Now, EBITDA per ton, your question was EBITDA per ton on feedstock basis, so that makes difference, very small basis. How much it will make? $21 million on what capacity? Yeah, feedstock production is. Huh? So it's $20 per ton, yeah. But well, you know, I just told you, we had a force majeure situation of mixylene in the first quarter, which hit the paraxylene profitability. So there are ups and downs.
I have a follow-up question. Kundika, you mentioned about the Brazil that has an Asian import parity pricings. I thought it was Brazil was an exporting country or the importing country.
It's an well, it is. They have capacities, but the pricing in the domestic markets are driven by import parity. So it's like Asia plus freight plus duties and all that. That's how the business works. And fortunately, Brazil is coming out of the recession. You know, the demand is going up. So it can be a perfect time for a right acquisition in May end. So you will say, if we are closing, then third quarter, you will have the benefit of that coming in.
Can I have a follow-up question?
Yes, please.
How about the Brazil one? Previously, before the spike increase, let's say in the margin in US, you talk about the PET margin that has been probably the highest in the world for the Brazil PET margin, even higher than US. But let's say that today margin in US increased. What is a comparison between the margin of Brazil and US now?
So US is a different market. The Brazil is a different market. Brazil has 14% import duty protection.
Okay.
So that's a significant, this is the highest duty protection anywhere in the world in PET. And so the whole deal is basically you price based on import parity. So you can say, I can't give you the numbers, but the margins will be highest in Brazil in anywhere in the world,
So
in per ton basis.
it's still valid to
No,
say
of
that
course it
it's
is
still
valid.
higher
Yes,
because
yes.
of the 14%.
Because of the 14%.
Okay. Even the recent increase in the margin for US.
No, the US margins are independent. So US
I know,
PET margins
it's not
are
related. I just
No, not related.
I know that it's
Actually,
not
Brazil was
related.
exporting to US some material, but you must have read recently US has declared anti-dumping duties on Brazil, Taiwan, Indonesia, which makes very less countries. So North America will now continue to benefit because North America needs capacity. So that's what it is.
So when this deal will start to contribute to your company, to complete
Which one? Brazil? Brazil, if we expect to close by 31st May, then it is an operating plant.
Yeah.
It's a sales portfolio, everything is there. So it should start contributing from June and fully in the third quarter.
Okay. Second, could you, give us idea how the contribution of the IPA within the feedstock EBITDA will be in the number that you show? Because last year I remember that we saw some negative impact from the high margin of the IPA. Last year to the PET. How about this year? What net impact?
So your question is impact of IPA lower cost on the PET margins. Naturally in Asia there's already an improvement because of lower cost of IPA, but major margin improvement in Asia in PET is driven right now by the demand supply situation. You will be, I don't think, you've given April numbers, right, Vishal? And April PET margins are already 200 plus, which never happened in PET. So, and May, June is already strong. So the whole world is driven by Asian PET margins because they are the import parity, right? China exports 2.6 million tons of PET around the globe. And the PET pricing in Europe and United States all is driven by import parities, and freight rates are going up because of high crude oil prices.
So the recent increase in the PET margin in US that we saw is actually not because of the U.S. itself, but because of the import.
All the factors together, because of Asia improvement, PTA margins improvement, PET improvement margins, and everything, you know. And they've been very low historically and not conducive for the replacement asset. Look at what Corpus Christi is going to cost to build, you know.
Okay.
It's very important to understand that cost of construction of a plant in the United States is maybe 3 times in China. And that's where the US Gulf Coast cost, and that's where it has to reflect on the margins. Otherwise, who will invest in these businesses?
Hi. So can I ask so I understand there are a few PET plants in China that are about to start or have started. So can you tell us in more details? Are they starting? And if that is the case, why would margins sustain?
You ask all the very important questions. We are keeping a very close track of the likely start of the plants. You know, the PET demand increases by 1.3 million tons a year. 1.3 to 1.4 million tons, and the capacities were not coming. So the capacity which is likely to come in China, all the plants in China are operating at reasonably full capacity, those who are running. So the new JAD of 500,000 is likely to come in July or something. There may be a Taiwan plant, but then all again the demand is there, you know. So it may consume. So it's very difficult mathematics actually. And always competitors will, or the market will say that this is starting now, but it always gets delayed, you know.
Let me add to that. We are not saying that the margins that are in April are sustainable. Because April margins are what, 237? Industry margin. $243 Asia PET margin in April. So we are not suggesting that is sustainable. But nor do we think a $100 margin is sustainable. So the truth is somewhere in between. And in quarter one, it was, what was quarter one average? Asia PET, quarter-wise, first quarter, 165. So this 165 is something that we have seen historically also. The new plants that are starting up, one is, okay, where does this material go? Secondly, when these new capacities start up, they take time to ramp up. So as the demand is growing at around 6% globally, there is enough time for it to get sort of consumed into the market. Plus, the producers of PET are also the producers of PTA. So the combined integrated margins for PTA and PET, I believe they're going to remain relatively higher than what we have seen over the last many years, because these people are investing quite significant amounts into refineries and paraxylene. So in order to fund those projects, they would need to show a healthy cash flow from the existing downstream businesses. So that is our view, that the margins that we are seeing currently in April and May, these may be relatively high, but they would settle at a level which is still quite accretive. And depending on how this oil prices, end up, but if price of oil is going to remain at $70 plus, then the global impact of Asian PET prices would be quite accretive for IVL, because most of the, whether it's a European sale or it's a Brazilian sale or American sale, the pricing in those continents is based on Asian import parity. So that is our take on the situation. I think the key important, the lots of key statements made by DK, but our 45% guidance for 19 over 17, which is about 1.46 billion, we are already at a run rate of 1.3 billion. And there are lots of new things to come. And we see that we could not capture everything in Q1. So there is still potential for us to capture more in Q2. So we are well on track to deliver on our objective of 45%. When we are ready, maybe at the end of second quarter, we can talk about improved guidance. But at the moment, things look good.
Sorry, can I ask a follow-up question? So what is going to be your M&A strategy going forward in the next 1.5 year?
Our M&A strategy has been diversified revenue streams, a blend of HVA and necessities, a geographical presence so that we can serve our customers globally. And our strategy is going to continue to be the same. So we would continue to track any strategic, let me rephrase the second part. Our first thing would be, organically growing and being very productive with our existing assets. Working with operational excellence in trying to improve our cost structure everywhere. And we have lots of plants globally, so we are able to benchmark and take the best out of each other's learning. Our second growth comes from M&A, and on that we see lots of avenues to grow. We will remain focused in our area of core competence. So our HVA businesses in automotive or on hygiene, they would take a priority. Our investments in necessities business, especially in geographies where we are not yet represented, will continue to draw attention from us. So there are things that we are looking at. The least of our worry, financing or our balance sheet's ability to fund growth is not a concern. Where we want to drive our strategy longer term is how can we grow beyond PET. Since in PET our market share is over 20% now, and there are some more projects coming on stream like Brazil. Hopefully the Corpus Christi deal gets done soon. There may be some other announcements on PET acquisitions. There may be some brownfield opportunities that we may do. So our PET, let's say we'll at least grow at the rate of 6%, which is our demand growth. But our objective is to grow at 12-13% per annum. And that 12-13% growth is going to come from partly acquisitions. And hopefully they come in the HVA space, because we want to keep that blend of HVA businesses, which are stable businesses. Necessities businesses you have seen. 3 years ago we were in the dumps. Today we are talking very positively about it. And that's how cycles are in commodities. So we'll enjoy this moment, let's say, in this improving cycle, but we'll keep our focus on both necessities as well as on HVA.
Hi, Yupapan from Macquarie. So given the strong spread currently, do you think it will attract a new investment or bring an ideal capacity to resume operation?
Yes, I think both, but hopefully more discipline. When we look at it in the last 5 years, these capacities were starting to get built in 2009 and 10, because if you can put up the tsunami chart, you will see that the margins that we enjoyed at that time was disproportionate to what it cost to build a PET plant or a PTA plant. Now is not that case anymore. The cost, the conversion cost is much higher than what it was in 2009 and 10. Plus, many people have burned their fingers in this business. Standalone plants who just came into this business without the core competence, without a strategy. We have seen, all of us have seen loss of casualties. So next time around it will be more disciplined, hopefully. But there would be, yes, there would be restart of certain plants. There would be some new announcements. But remember, when the demand is growing at 6% for all polyesters, let's say, and all polyesters is what, about 70 million tons, fibers, polymers, films. 6% is 4 million tons of, DK mentioned earlier 1.4 million, which was only PET. But you need 4 million tons of polymer capacity, or you need 3 million tons of PTA capacity every year. Or you need, 2 million tons of paraxylene capacity. So it is a high growth business. So we should not be too alarmed about new capacities being announced or built. As long as it's not as it was in China, where every province was competing to build a polyester plant. And we don't see that happening. I think people have moved on now.
Hi, Kunalok, Napat from Krungsri Securities. I have a question on the PET because PET margin. I remember you mentioned about we are changing a contract that we are selling to customers in the West by raising margin above our feedstock by $30-40 this year, and based on the PET margin in the West. In April, that we said it will not be sustained at $260 to $70 because of the oil price. My question is, do we capture we cannot capture the margin at this level because of the fixed margin? Is that one reason? Or another thing that I want to touch on is on the anti-dumping duties in US that announced this month. Is it because of this issue that push up the PET margin in the West?
So what I said about not being able to sustain was only Asia PET, not global PET. So the West PET, as you can see in the statistics that we circulate, the West PET margins are not much increased. If I see on a quarter-wise basis, the current margin of 237, 243, last quarter was 237, third quarter last year was 230. Back in 2014, the margins used to be the same. So the paper in front of me doesn't have the 2014 margins, but what we analyze internally, we have not yet reached back to 2014 margins.
Okay, but when we sell PET, are we fixing the margin?
Yes.
We fix the margin. So if the industry margin is higher than what we fixed, meaning that we are selling at fixed, that what we fixed with the customers.
Yes. So going back to what we've been saying since IRP days, the oil price impact on us is not material because we don't want to take the risk of oil price. So we don't have when we have a fixed price, we either hedge it against our stock or we go and hedge in the market the raw material. What we want to, our entire business on PET and PTA, on the necessity side, is trying to get our spread. So we want to just make sure that our spread is what we require for our business. What happened last year, 1 year ago or 1.5 years ago, the IPA prices went up quite dramatically. So the PET spreads came down in the West, partly because there was a oversupply expected to come from Corpus Christi, and there was an increase of IPA price. And the increase of IPA price was quite substantial. As IVL, we saw that benefit in our feedstock. But on the PET side, we had to pay for that IPA. So what we see now is, since the collapse of, since the industry structure, the way it has happened in the last 1.5 years, now there is more stability of margins. We have been able to, I think in our prepared statement, we said 80% of PET margins are contracted in the West. So the answer lies in that 80% of our PET margins in the West are contracted. So whatever you saw us achieve in Q1, more or less you can expect us to achieve that in the rest of 2018. Asia is more on spot. So in Asia we would not have, I think it must be, DK knows better, what do you say, 20% contract, 80% spot?
Nothing is raw material.
So
marketing.
Which is all spot then. So in Asia, predominantly everything is like spot. So as these margins are going up in Asia, second quarter would see a very healthy spread. And I don't think that is sustainable. 243 plus the premium of domestic market. This is industry spread. IVL normally has a premium to this spread. So that is what I mean. So West is 80% contracted, so sort of we can see it, and it's a pass-through mechanism.
And do you think that the margin at this level is already reflected the anti-dumping duties that will be effective next month?
So the anti-dumping duties is something, the case was filed in September, I believe, September 2017. And the Department of Commerce, or that regulator, accepted that application in November. So since November, it was anticipated. The preliminary announcement of how much is the duty was made end of April. And the final outcome is only going to get known in November, I believe. So there is now preliminary duty already applicable. But the idea was not margin enhancement. The idea was there was too much of undisciplined imports at the cost of local producers. Like I said, the PET margin in North America in 2014 was higher than what it is today. So we have not yet fully recovered the margins of 2014.
By the way, how much is 2014? I forgot.
Yeah, even I don't have the number right in front of me. Vikas, that is there? Oh, it is in the chart. 2013 was 255. 2014 was 248. 2017 is 203. So first quarter was 243. These are all industry, these are not IVL. So it is not that the margins we are seeing today are reflective of anti-dumping, or it is just that the cost to build a plant in North America or in the West is pretty high. There has been inflation, so there is also the conversion cost has gone up. Even IPA is more expensive. So it's just reflecting all of that.
Hi, Yupapan from Macquarie again. So can you explain to us again why the Asia PET spiked in April, and what do you see as a normalized for the margin?
So, why spike, right? As I said, world demand grows by 1.4 million tons. You suddenly had this disruption in Europe and America. China went and contracted exports and suddenly found that China doesn't have material for domestic market. So mismatch between the capacity and demand. Now this is continuing in the second quarter completely. Now there's a seasonality in the demand, don't forget about it. Second quarter and the summer season will still have, and the whole pipeline is getting tighter because everybody is looking for material, so the material gets tighter. So as outside China, which plants are getting built? There's only one in Vietnam, and one we are talking Corpus Christi. So as Mr. Lohia was mentioning, many of the standalone plants failed, and which some of them acquired. So, and outside plants are all operating at full capacity. China plants are operating at full capacity today. So it will take, but what Mr. Lohia is trying to say that sustaining Asia margin is at 240 is too high, So it will come down, but it will be on the third quarter, fourth quarter, it may normalize, but not to those levels for the previous. So probably that answers the question,
And I think I read a good report on this. The waste import ban into China, that created a lot of demand for virgin material. Mostly for fibers, because that's where the waste was, the recycled fiber was going. But since there was a new demand for polymer, PTA prices have also gone up. When PTA goes up, there's a sentiment improvement. Fiber has gone up, PTA has gone up, PET has gone up. So apart from the factors that DK mentioned, there is a healthy sentiments in the industry. And when you think of the report I read was quite, I thought it was quite right. The announcement for waste import ban was already done somewhere last year, but it got applied from 1st January 2018. So people would have imported more material, and all of that would have got consumed in January, February. So the real impact of the waste ban import can be only felt from March onwards. So that is when now we see a spike of polymer price or polymer margin, because of the lag impact. People imported more in fourth quarter of 2017, the waste.
Just to follow up on the PET recycle, from what I understand is the ban effective the 1st January 18. Is this going to because of the environmental issue, and the ban, the environmental issue coming from the production process, or is it coming from something else? Because what I'm concerned is this plant, when they were shut down, can they change the technology and come back to produce the recycled products?
So it's a bit complicated, but basically when we talk about bales of waste getting imported, I don't know exactly why it was banned, but China is taking a very leading position on the environment. So it's a ban not only on PET but all plastics, number one. They've also recently said that they will also ban intermediate plastics made from recycled product. Earlier the ban was only on bales. I think China is just being overcautious that together with the waste what sorts of ground, what sorts of sand, what sorts of litter comes into the country. So from a hygiene question, it also can bring a lot of medical things, medical issues. So it's not, because when you get a bale, and it's curbside bale, it can have a lot of litter in it. So I think the ban is from that point of view. It is creating an opportunity for some people, let's say in Bangladesh or Vietnam. Maybe Mr. Gill can explain a little bit more about the impact of the waste ban, since most of that waste will recycle back into fibers. So what is he seeing, and where is this? I'll have to close this. So where are you seeing the opportunities on waste?
See, there was a indiscriminate import of plastic waste into China, because that had become a recycling hub for the world. So a lot of low quality bottle waste was coming from Europe and from United States into China. And that was leading to, as Mr. Loya mentioned, unknown consequences on the environment. And Chinese government, I think they took the right step to put their own house in order. So they banned it, and giving sufficient notice. Of course, the ban was announced somewhere in the middle of last year. And therefore, as Mr. Loya mentioned, there was a spurt of activity, etc., etc. So those things apart, recycling will continue, but this will encourage recycling outside China. So now the countries who are creating waste, they will recycle it themselves. So that is what is happening in Thailand. We have put up a recycling operation in Nakhon, and we are finding it that we are able to now load those lines fully, and there's demand for the product. So this is in fact healthy, I would say. And when the waste is processed locally, there'll be more discipline. So there'll be constant feedback going back to the institutions to improve the quality of waste and to handling procedures. Since China had become a dumping ground, so people were just dumping whatever it is the way it was coming. Now I would say more discipline in the industry, but certainly this will get spread out. So the impact of sudden 7 to 8 to 9 million tons of that recycled kind of fiber which was going in, that is now will be replaced in China by the virgin. That's what is leading to this spurt. But I would say that now gradually China will also start recycling its own waste, and other countries will do it. It will get more spread out. There won't be one single recycling hub for the world, I would say.
Please continue. Any other questions to us?
One more question from me. What is the cost per ton for Asian PTA, and when do you expect the PTA EBITDA per ton to show the improvement?
For IVL?
Yeah, for IVL, sorry. Yeah.
Well, we cannot give you the cost, but let's understand the PTA business. It costs us $700 per ton to $750 per ton to invest in new PTA plant. And even if you talk of 6 years EBITDA, you're talking of $125 per ton. To create that replacement return, you need a margin of $170, $180. Today, outside China, the margin has become 135, 140. So there's a lot of steel upside to go. The big thing is that this will have impact in Europe. Because now Europe is still on the historical contract at import parity. And if the euro weakens, then import parity increases. Then it gets translated in 19 contracts, or the 18.5. So all these there's a lag between the process, So you will see the entire chain is moving. You cannot have a commodity business continuously riding on a capital investment which is below return. People don't invest. So we saw the investment spree after 2011, when the 11 margins were high. That hang-on continued because China return were in 1 year, 2 years. The PTA margin used to be $240. Now those capacities are getting consumed or rationalization of the assets is happening, and then now you slowly go up to the replacement level. That's part of the, and demand is strong. That's all. And I think recycling, as Mr. Gill mentioned, will migrate to the countries where it is produced. And China is very sensitive today about the pollution. All the actions they are taking is to make sure that the pollution is minimum, which also creates an opportunity in polyester chain,
And that's a good point, that in China they also have banned the use of coal for utilities in quite a few major cities. So that would have increased the cost for PTA producers in China. So between $180, let's say 180 should be the across the cycle margin. Whether you call it a hope or a reality, we'll see. But 180 should be across the cycle in order for the industry to get a decent return, not a very healthy return, but a decent return. Then it will differ player by player. If you have your own captive PET, if you have it in the same country, if your logistic cost is low. So all that will make an impact on the returns.
Okay, there doesn't seem to be any other questions, but the IR team will hang around after the meeting. Thanks everyone for coming today. This meeting was recorded and will be up on the website in case you missed something in your notes. So thanks once again for coming, and we'll close the meeting now. Bye-bye.
Thank you.